So again, you're welcome to financial reporting class. And today, we are going to be starting up a new standard. And that standard is IFRS 15 that deals with revenue from contracts with customers. Revenue from contract with customers. So the first thing here is the core principle or objective of IFRS 15 of this standard. See, the core principle or the objective of IFRS 15 is to ensure that the consideration, in fact, that the amount recognized as revenue in the statement of profit or loss depicts the consideration expected from the transfer of promised goods or services. So, the objective of IFRS 15 is to ensure that the amount that is recognized as revenue in the statement of profit or loss depicts the consideration expected from the transfer of promised goods or services. This goes to show that when you recognize, let's say, 100,000 in your P&L as revenue, that 100,000 must represent the value of goods that you have transferred to a customer. Gone are the days where you will collect money and you haven't done the work or you have not delivered the goods and you still go ahead and recognize revenue. That does not work anymore. This standard frowns against that. That before you can recognize revenue in P&L, you must have delivered the service. So we want to ensure that the amount that is recognized as revenue should reflect, should depict the money you're expecting for the work you have done in such a way that if you have a service that is going to earn you 50 million and you have only done, let's say, half of that service, you should only recognize 25 million in your books. Whether you have collected the money or not, that is not the focus here. The focus is that you should only recognize revenue for the work done, for the goods transferred. And that's the objective. That's the core principle here of IFRS 15. Now, the second thing is recognition and measurement of revenue. So, revenue is recognized and measured using a 5-step model. And this 5-step model are this step 1. This talks about identify the contracts with a customer. Step 2 talks about identify the separate performance obligation. Step 3 talks about determine the transaction price. Step 4 talks about allocate the transaction price to the separate performance obligation. And step 5 talks about recognize revenue when performance obligation is satisfied. So the 5 steps involved in revenue recognition. You need to know these 5 steps by heart. They can ask you. So step 1 is to identify the contract the customer. Step 2 is to identify the separate performance obligation. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the separate performance obligation. Step 5 is to recognize revenue when performance obligation is satisfied. Now, we would pick each of these steps one after the other and explain it. And as soon as we are done with that, then we are done with this topic. So the step 1 that talks about identifying the contract with a customer. So the key word there is a contract. And a contract is an agreement between two or more parties that has legal or economic consequences. It's an agreement between two or more parties that has legal or economic consequence. And a contract qualifies under IFRS 15 if it meets the following criteria. Number 1, the contract has been approved by the parties and they are committed to the terms of the contract. So the contract has been approved by the parties and they are committed to the terms of the contract. Number 2 is that the parties' rights in the contract, has been identified. Number 3 is that the payment terms has also been identified. Number 4 is that the contract has a commercial substance, that is, there is a change in cash flows, risk, and timing. And number 5, it is probable that the seller will collect its consideration. And a bonus point is that the contract can either be in writing, orally, or in line with any other customary practices in that nation. Okay. So a contract is an agreement between two or more parties that has legal or economic consequences. The following criteria are required for a contract to qualify as a contract in line with IFRS 15. The parties must have approved it. They must have signed it, which also shows their commitment to the contract. Their rights in the contract must have been identified. The contract must specifically state what each party is expected to do. The payment terms also in the contract must also be identified. We need to know what the payment terms are. We should be able to identify the payment terms. And also, the contract must have commercial substance. And when we say commercial substance, we are saying there must be a change in cash flows. There must be a change in risk. There must be a change in time. In the sense that one party must be paying money. One party must be taking risk. One party must be putting his time into, putting his effort into this transaction. There must be commercial substance. Meaning there should be commerce. They should be buying and selling. Somebody must be taking risk. Somebody must be paying. Somebody must be putting in effort. Commercial substance. Also, we must be able to say for sure, at least over 50, there should be a 50% chance that the seller is going to collect his money. It is probable that the seller will collect its consideration. And finally, the contract can either be in writing, orally, or in line with any other customary practices in that nation. That's the step 1. Now, if you look at these contracts, they said a manufacturing company in ABC Limited signs a written contract with SYZ Corp to supply 1,000 units of a product at 15 naira per unit. The contract specifies delivery in batches over 3 months and payment to be made within 30 days after each batch is delivered. And SYZ Corp has a credit rating. If I want to analyze this scenario given to me, I'll tell them that the above contracts includes the following elements. Number 1 is that the parties have approved the contracts Because they have signed it. It shows that they have approved it. They signed the contract with XYZ. It means they are also committed to it. Number two is that the parties' right in the contract is specified. Specified. Like XYZ supply 1,000 units of a product. That's his own right in that contract. That's his own obligation in that contract. Also, the payment terms is also specified. Which is the payment within 30 days is required. And there is commercial substance because somebody is taking risk and somebody is paying. Because finally, it is probable that ABC Limited will collect its consideration. It's probable because XYZ has a strong, they told us that XYZ has a strong credit rating. So the contract is therefore a valid contract. It has all the elements. But when you look at this second one, they said a software company called TechSoft enters into a contract with a small startup, Newco, to provide a custom software system for 100,000. The contract includes a 12-month development timeline. It includes payment upon completion. And Newco Limited has a weak financial history and might struggle to pay. We want to analyze this. I'll say the contract has been approved by the parties. They have approved it because we're told that they entered into a contract. It shows that they are committed to it. Number two, the parties' rights in the contract is specified, that is, to provide a custom software system. Also, the payment terms is specified, that is, upon completion. We were told in a contract that payment will be made upon completion. Also, is that there is commercial substance. Cause there is a change in cash flows, risk, and timing, and it is not probable that TechSoft will collect its consideration because New Co Limited has a weak financial history and might struggle to pay. So, following from the above, the contract is not a valid contract. Contract is not a valid contract. So you will see that for this one, even though he met all the other criteria, but for the fact that we could not identify that ability to pay, that it will be, is probable that the seller will collect his money. On that basis, we said that the contract is not valid. It's not a valid contract. So it's important. So note that where a seller collects a consideration before the delivery, of the promised before delivery of the promised goods or services, or where the above criteria for a contract is not met, the consideration received or collected will be treated as a contract liability. Meaning that you cannot recognize such as revenue. You would rather recognize it as a contract liability. And that's what we are talking about. And that's it for the first part of this step one, which is identifying the contracts with a customer. Any questions? Now, the second one is contract modification. Contract modification. What we are talking about here is that where a contract is carried out at the same time with the same customer, the contracts can be combined if it meets the following criteria. Number one, the contracts are negotiated as a package with a single commercial objective. Number two is that the price of one contract is dependent on the price or performance of another contract. Number three, the goods or services of the contract can be delivered as a package. So when we talk about contract combination, we are saying that you can combine a contract that you signed, that you agree with the same customer at almost the same time. You can combine them together if those contracts, if they are negotiated as a package with a single commercial objective, if the price of one contract is dependent on the price or performance of another contract, and also if the goods or services of the contracts can be delivered as a single package, then you can go ahead and combine them and see them as a single contract rather than see them as separate contracts. Any questions? Now, let's look at this example. If you have a consulting firm, Advisory Limited, he signs two contracts with a client. A 50,000 business strategy review and a 30,000 implementation plan. We're now told that both contracts were negotiated together and the strategy review directly impacts the implementation plan. So if I were to analyze this, tell them that the contracts can be combined because they are negotiated together and they are dependent on one another. So you can combine them for that reason because it meets some of these criteria. Also, he said a company called TechSoft Limited enters into two contracts with a customer. The first contract is a software license for 100,000. The second contract is ongoing maintenance and support for 30,000 over 3 years. We're told that the customer is given a discount on the maintenance, only if they purchase the software license. Again, we were to analyze this. The contract should be combined because the price of one contract is dependent on the price or performance of another. Because they say that the customer is given a discount on maintenance only if they purchase the software license. So they have interdependent pricing. So you can combine them for that reason. Another scenario, we're told a construction company, Build Co Limited, signs 2 contracts with a property developer. Land sale for 500,000 and contract 2, construction of a building on the land for 2 million. The contract was signed separately, but are part of the same negotiation. The customer will not purchase the land without the construction contract. Again, the contracts can be combined because they were negotiated as a package and they are dependent on one another. They are dependent on themselves because the customer will not have purchased the land without the building. So ultimately, they would have a single performance obligation. You have a single performance obligation. Ultimately, the output is the property itself. They will have a single output. We also have a machinery manufacturer, Machine Limited, enters into 2 contracts with the customers. Contract 1 is sale of a machine for 1 million. Contract 2 is customization services to modify the machine for 200,000. The customer cannot use the machine without customization, and the 2 contracts were negotiated together. For this one, the contracts can be combined because they are dependent on one another and they are negotiated as a package. And finally, an IT service provider, CloudTech Limited, signs 2 contracts with the same customer. Contract 1, cloud storage services for 50,000 per year. Contract 2, cyber security consulting for 20,000. The contracts were negotiated separately, and the pricing of one contract does not affect the other. So for this one now, the contracts cannot be combined. Costs, they are negotiated separately and they don't have interdependent pricing. So all of this scenario is just for you to get used to contract combination, that you can only combine contracts together when any of those three occur, either when the contract is negotiated together as a single package, or they can be the goods or services in the contract can be delivered together, and also where the price of one determine the price of another, or when the price of one is dependent on the performance of another. Then in those cases, you can combine contracts together. Now, still on step one is contract modification. So a contract modification is a change in the scope or price of a contract. Is a change in the scope or price of a contract. And a contract modification, modification will result in a separate contract if the following criteria are met. So when there is a change in the price, or when there is a change in the scope of a contract, it will result in you will see it as a separate contract. You will not need to adjust the existing contract. You will treat it separately as a separate contract if the following criteria are present. Number one is that the change in the scope of the contract is because of an addition of promised goods or services. That the change in the scope of the contract is because there was an addition of promised goods or services. The customer says that he wants more goods. And also, the change in the price of the contract represents the standalone selling price of the goods or services. The change in the price represents the standalone selling price of the goods or services, meaning that the price at which you're selling those additional goods that the person is buying is the standalone selling price. And when we say standalone selling price, is the price that the entity sells the goods or services separately on its own, separately, not commit tautology. So standalone selling price is the price that the entity sells the goods or services separately. That ordinarily, that's how much they will have sold it. The customer came and say he wants more goods, and you need to then sell it to the customer. The price at which you're selling those additional goods is the price you would sell those goods normally, separately. So that means it's a standalone selling price. It represents standalone selling price. Let's look at this scenario so that those explanations will sink. It says a construction company build co enters into a contract with a client for a building project at 500,000. During the construction, the client requests additional feature for an extra 100,000. The additional feature are priced at market prices. So here, trying to analyze this, I will say the contract modification should be treated as a separate contract because the change in scope is as a result of an additional feature requested by the customer, and the change in price represents the market prices, which is the standalone selling price. So we are going to see that modification as a separate contract on its own, because the additional features were at market rate, so they represent standalone selling price. Another one is a software company called TechSoft signs a contract to provide accounting software for 50,000. After 3 months, the customer requests an additional inventory management module for 20,000, which is priced at its standalone, selling price. Again, the contract modification should be treated as a separate contract because the change in scope is an additional goods or services, and the change in price represents the standalone selling prices. So you can see the contract modification as a separate contract. Another scenario says that A construction company buildco signs a contract to build 10 houses for 1 million, which is 100,000 per house. After completing 4 houses, the client requested 5 additional houses for 95,000 naira each. Here, the contract modification cannot be treated as a separate contract, but the existing contracts will be updated because the change in price does not reflect the standalone selling prices of the houses, because the additional houses were sold at 95,000, while the standalone selling price is how much? Is 100,000. So for this reason, that contract modification will be seen as an adjustment to the existing contract. We will need to adjust the existing contract. You cannot see that contract modification as a separate contract. Also, we were told the telecom company Netcom signs a 3-year internet service contract with the customer for 30 naira per month. After 1 year, the company offers a discount. The company will pay 25 naira per month for the remaining 2 years. Yeah, the contract modification will not be treated as a separate contract, but the existing contract would be updated because the change in price does not reflect the standalone selling price of the services. The additional service and also there was no change in scope. There was no change in scope here because they have already signed the 3-year contract right from day one. So there was only a change in price, which does not reflect standalone selling prices. And finally, a consulting firm advisory limited signs a contract to provide financial advisory for 100,000 over 6 months. After 3 months, the client requested for 2 more months, but at no extra costs. So the contract modification will not be treated as a separate contract, but the existing contract will be updated. Pause. The change in price does not reflect the standalone selling prices as the additional services be rendered at no extra costs to the company. Okay, so those are just scenarios for you to get used to contract modification. So you can only treat a modification as a separate contract if the change in scope is because of addition of goods or services, and the change in price actually reflects the standalone selling prices. If those two does not exist, then you cannot see that modification as a separate contract. Now, the step 2, which is to identify the separate performance obligation. To identify the separate performance obligation. Okay, Joseph, you want to ask a question?
Yes, sir. Hello, sir.
Yeah, I'm with you. Go ahead, please.
My question is, supposing a contract is awarded to a client, and then in the course of the execution of that contract, there was issue of inflationary tendency that affected the original price with which the contract was awarded, and then the client later now apply for variation. In this scenario, will it be addressed as a contract modification?
Yeah, of course, it is a contract modification. It is a contract modification. It will just need to update the existing contract. Okay, that will not be treated as a separate contract because the change in price is not, in fact, the change in scope, there is not even change in scope. It's just inflation, which is a common thing. So we are not going to treat that as a separate contract. We will just update the existing contract, and that's it.
Okay, sir. Thank you, sir.
Yeah. Now let's go to step 2 that talks about identifying the separate performance obligation. So what are the separate performance obligation here? So the first thing is that, you see, a contract usually contains a promise to transfer goods or services. You see, these promises to transfer goods or services are known as performance obligation. That's what we call performance obligation. Those goods or services you say you want to transfer, they are performance obligation. And see, revenue is recognized for separate performance obligation that is distinct, quote and unquote. So we usually recognize revenue for separate performance obligation that is distinct. And when we say distinct, so a separate performance obligation, is distinct if it can be sold separately. You can sell it separately because it has a distinct function. It has a distinct function and a distinct profit margin. So, I mean, this story is coming from when you want to recognize revenue, you recognize revenue for separate performance obligation that is distinct. And when we say a separate performance obligation is distinct, it means that you can sell it separately. And you can only sell it separately because it has a distinct function and a distinct profit margin. So a distinct function means that the performance obligation, or what we call the goods or services, can benefit the customer on its own or together with other resources that are readily available to the customer, or together with other resources that are readily available to the customer. That's what we mean by a distinct function. When we say a performance obligation has a distinct function, it means that the customer can benefit from that goods or services on its own or together with other resources that are readily available to the customer. Yes, like if you buy a fan, for example, now, the fan can benefit, you can benefit from that fan, standing, well, let's say standing fan on its own. And this is because even though you have to plug the fan to a socket, you need electricity for it to work, that doesn't mean it's not functioning on its own. right? So you are just using it together with other resources that is expected to be readily available with you. Just like you buy a bio, for example. It's only useful if you can use it to write on another platform, right? So that does not mean that the pen is not useful or is not functioning on its own. It can function, but you need to use it with other resources that are readily available to you. And a distinct profit margin means that the goods or services are separately identifiable. They're separately identifiable. And this means that the goods and services is not dependent on another good or services. That's a distinct profit margin. So identifying the separate performance. See, I'm giving you a story here. Is interlinked. I'm just going from one step to the other, like that, to tell you the entire picture. So I started by saying that a contract, what you find inside that contract is a promise to transfer goods or services. And these promises, we said they are no less performance. That's what we call performance obligation. It's just the promise you have made to transfer goods or service. That's the performance obligation here. And when you want to recognize revenue, you recognize revenue for separate performance obligation that is distinct. So every distinct performance obligation, you need to recognize revenue for them separately. And when we say a separate performance obligation is distinct, it simply means that you can sell that performance obligation or goods or services separately because it has a distinct function and a distinct profit margin. And when we say a distinct function, it means that that performance obligation or that goods or services can benefit the customer on its own or together with other resources that are readily available to the customer. And when we say a distinct profit margin, it means that the goods or services are separately identifiable, which means that they don't depend on another goods or services. They are not an input to another, it's separately identifiable. They don't depend on another goods or services. Scenario one. We have a construction company, Buildco Limited, signs a contract to build a shopping mall for 50 million. The contract includes design and architectural services, foundation and structure construction, electrical and plumbing installation, interior finishing. So if I want to analyze this, the performance obligation, I would say that the performance obligation in the contract are not distinct because they don't have a distinct function, a distinct function, and a distinct profit margin. All the services in the contract are dependent on one another. Because if you look at this service, you cannot go to foundation and structure without design and architecture. You cannot go to electrical without the foundation and structure. You cannot go to interior without. So they are not, each of them is not distinct. So we are going to see all of them as one service. We're going to see all of these services as one service. So when you're recognizing revenue, you cannot, BuildCo cannot recognize revenue separately for architecture. It cannot recognize separately for, it is going to recognize revenue for everything as one, and they will see them as a single performance obligation because they are one. So the entire services is seen as a single performance obligation. Now, the case two, a software company called TechSoft Limited signs a contract to provide software license for 500,000, installation and customization for 100,000, 1 year technical support for 50,000. If I'm to analyze this, I will say that if the software license cannot function without the customization, and only the software provider can install, and the 1 year technical support is essential for the software license, then the entire service is seen as a single performance obligation. However, where the software license can function without the customization and 1 year technical support, then each service will be seen as a separate performance obligation that is what? Distinct. Will be seen as a separate performance obligation that is distinct. Another scenario, we have a telecom provider, a Telenet Limited, signs a 2-year contract with a customer to provide free phone at contract signing and charges 18 naira per month for telecom services. If I'm to analyze this, see the free phone is a separate performance obligation that is distinct because the customer can use the phone with any other service provider. With any other service provider. Also, the telecom service is a separate performance obligation that is distinct because the service can be used with any other phone, not necessarily the one that they gave in. Therefore, the services in the contract, the services in this contract are separate performance obligation that is distinct. We also have a pharmaceutical company, Pharma X Limited, grants a license for a new drug formula to Biomed Limited, a 5-year exclusive license to manufacture and sell the drug, ongoing R&D support. We want to analyze this again. I will say that if the license can function without the ongoing R&D and regulatory updates, the services will be seen as a separate performance obligation that is distinct. But if the license cannot function without the ongoing R&D supports, and regulatory updates, the entire services in the contracts be treated as a single performance obligation. And that's the end of step 2. Any questions? Now, step 3. Step 3 is to determine transaction price. And transaction price is the consideration expected from the transfer of promised goods or services. So transaction price is the consideration you're expecting, the money you're expecting for the transfer of goods or services. So transaction price will exclude the money collected, on behalf of third parties. Transaction price will exclude the money collected on behalf of third parties. So any money that you collect on behalf of third party, like VAT, you don't include it as part of your transaction price. And transaction price is like the revenue, the amount that you recognize as revenue. So we don't recognize VAT as part of that. We don't. Transaction price can be a fixed consideration, a variable consideration, a non-cash consideration, and they are usually adjusted for time value of money. You have to adjust the transaction price for time value of money. You cannot sell goods to somebody and you tell the person to pay in 1 year's time or in 2 years' time. You cannot recognize the nominal amount anymore. You have to recognize the present value of that amount. It has to be the present value you will now recognize, not the nominal, because it's much later in the future before before the person would pay. So now let's use examples to make it clearer. You said a construction company, Buildco Limited, signs a 100 million contract to build an airport, and the contract includes 10 million bonus if completed within 24 months and 5 million penalty if delayed beyond 30 months. So for a year now, so the transaction price will be 110 million if the construction is completed within 24 months. Because they said you will get a bonus. So transaction price will be, but however, transaction price will be 95 million if construction is delayed beyond 30 months. So since they told us that you will suffer a 5 million penalty if construction is delayed beyond 30 months. So that would represent, by the time we move that from the agreed price, we'll get the transaction price. Another scenario, we're told that a machinery supplier, Equip Co. Limited. Yeah, Elozo, you have a question?
Yes, sir. The question is, what if it took the company 25 months to complete? That is in between these two amounts given. How should we see that?
You pay penalty. No? That means it will just be the 100,000. It will just be the 100 million in that case.
All right, sir.
Yeah. Yeah, Femi.
Yes, sir. So in this case now that we have, how do we now how do we recognize the amount of sorry, the revenue now? Because the contract is supposed to take, okay, if you work within 24 months, or if you work above or within 30 months, the penalty and the fine. So how do we now recognize it? Is it as we are working that we'll be recognizing the amount that we have earned, or I just want to know how do we put it down?
Anyway, we'll get there in step 4 and all of that. But is as you are working, as you are working, you'll be recognizing the revenue gradually. You
Oh,
see
okay,
it,
sir.
you will still get it, but it's gradually small, small. You cannot recognize the whole of the 100 million now. So small, 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 small.
Okay.
Right. So by the time you yourself, you see that you have delayed beyond 30 months, then you know that your revenue cannot be more than 95 million that you can recognize, because at that point you will have known. So that's the way that works.
Sorry.
Okay, Moses.
Right. So my question is, if, for instance, you exceed 30 months, and you know you have a fine of 5 million to pay, you're going to prorate that 5 million penalty, or you're just going to recognize it as a single entry in the financial statement?
So you will not even recognize it at all, because your transaction price now is now 95 million. So what you just show as revenue in your books is just 95 million.
Okay, no problem. Okay.
Because that's the transaction price. Okay, let's look at another scenario. So a machinery company, yeah, okay, go ahead, please.
Yes, sir. Sorry, sir. From that question that I think was it David that asked, when the transaction is between 25 months, you said that it means you're going to use the 100 million. I was thinking that the period given is 26 months. If you're able to meet the target within 26 months, whether either you is 26 months or below 26 months, you should be able to get that bonus. And you said that if it's 25 months, you can use the 100 million. So I don't know.
You know that is they told us that if you complete within 24 months, that's when they will give you bonus. So he now said that what if it's 25 months? You won't collect bonus again because that means you didn't complete it within 24 months. So there's no way they can give you bonus anymore. He said if you complete it within 25, that means you are late. Bonus is gone. So that's how that would work. Okay. So here we were told that a machinery supplier Equipment Co. Limited sells equipment to a customer for 5 million, but payment is deferred for 5 years at 0% interest. So how do you recognize revenue here? So the revenue will be adjusted for time value of money by recognizing the present value of the 5 million as revenue. So, the applicable discount rates can be the MPR or the borrowing rates in that nation. Additionally, an interest income will also be recognized at the end of each year. So we are telling the customer to pay in the next 5 years. To pay 5 million in the next 5 years. So, and you have already sold the equipment to the customer. So the way it work is that what you recognize as revenue is the present value of that 5 million. That is what you recognize as revenue. And you would also recognize an interest income equivalent to the discount rate times the opening balance, which I think I explained to you under provisions. That whenever you discount to present value, you would need to unwind the discount. You will need to unwind the discount. And because of that, you would recognize interest income as well at the end of every year, like that, with that unwinding of discounts in this case. Another scenario. It says a technology firm called TechSoft Limited provides consulting service in exchange for 1,000 shares for a startup instead of cash. So in this case now, so the consideration here is non-cash. So the revenue recognized will be the fair value of the non-cash consideration. So whatever it is as the market price of the shares, that's your revenue that you're going to recognize in your books. And final scenario, this one says a consumer goods company in fast goods sells product to a retailer for 1 million, but agrees to pay the retailer 200,000 for in-store marketing. Okay. So I sold goods to a retailer, and I'm now paying the retailer for marketing his goods for me in his own store. Okay, people do this a lot. Just to market within their store. If they market, they will give them like some freebies, some money like that. So if I will analyze this, I will say the transaction price here is 800,000. That is 1 million minus the 200,000 that is getting. Do this particular question as your assignment. Let's see if you can attempt it. Okay, that's the end of step 3. We have looked at series of questions to demonstrate it. Do we have any questions? Okay. Let's then go to step 4. That says allocate the transaction price to the separate performance obligation. So what are we saying in this step 4? You see, the thing is that where an entity provides a bundled services, which it also provides unbundled. That is, if, let's say, you go to a gym, you pay gym subscription, and if you need personal trainer, you pay for that separately. They provide that service separately. But they now decide to come up with a package and say that, okay, we want to combine the two services together as one, just so that they would reduce the price and encourage people to do the two. So they are providing that service bundled. That's what I mean by it. Where an entity provides a bundled services, which it also provides unbundled. You see, the separate performance obligation in the bundled services must be recognized separately as revenue based on their standalone selling prices. Based on their standalone selling prices. So where an entity provides a bundled service, which also provide unbundled. So each of the services in the bundled services must be recognized separately as revenue based on their standalone selling prices. Let's use examples to demonstrate this. So if you have a company that sells a package for 10,000, and this package includes software license, delivered upfront, and 1 year technical support delivered over time. And we're given the standalone selling price for the services as this. You see, if I want to analyze this, the separate performance obligation in the package should be recognized separately as revenue based on their standalone selling prices. So don't say because we are selling it as a package, you then present the two together as revenue. No, they are separate services. They are distinct performance obligation. You sell them separately. So you should recognize them separately as revenue. So in such a way that in your notes, you have software license, you recognize revenue of 8,000 around that. You have 1 year technical support. You have 1 year technical support. You recognize revenue of 2,000, though this one is over 1 year because you cannot recognize the entire revenue immediately. So, but the information here, the principle here is this: you need to recognize revenue separately for each of the two, separately. Another scenario, a gym sells 1 year membership, which is 1,2, bundled with personal training sessions, which is 300, for a total package of 1,2 instead of 1,5 if sold separately. So the standalone selling prices: membership 1,2, personal training 300. The total standalone selling price is 1,5. Okay, so you get the idea here. So ordinarily, gym membership is 1,2. A personal training is 300. So if they are sold them separately is 1,5, but they bundled it together as a total package and say, okay, we'll come and take the total package as 1,2. Again, the separate performance obligation within the bundled services should be recognized separately as revenue. So you have membership, you have personal training. As revenue based on their standalone selling prices. So their standalone selling price, membership is 1.2, while this one is 300. So ordinarily, the addition of the two is ordinarily 1,500. So you take a proportion. You do 1.2 divided by 1.5. What does that give us? Anybody have a calculator there?
0.8.
Sorry?
1.2 divided by 1.5, 0.8.
Okay. Let's say 80%.
0.8.
Okay, thank you. And this, of course, will be the balance, 20%. So the revenue will recognize for membership, we'll recognize 80% times. How much are we collecting for the two services? 1.2.
1.5.
No, 1.2. We are doing the two together as 1.2. So it's the 1.2 we are sharing among the two of them. So what's 80% of 1.2?
960.
960. And this will be 240. So even though they are giving the two services bundled, we will need to recognize the separate performance obligation separately as revenue based on their standalone selling price. So membership and personal training. So, and you will see that I use their standalone selling price to get like a proportion, a ratio for sharing the total package. Right? So is this the 1.2 that they actually received that I shared? So what we will recognize for revenue as revenue for membership fees will be 960. What we would recognize as revenue for personal training fees will be 240. So that's what that step 4 is talking about. Let's look at another example. So this say that a company sells a bundle for 50,000, including software license. SSP means standalone selling price is 40K. For the customized training, they say they don't know the standalone selling price. So if I will analyze this, for this one, is quite straightforward because the SSP will represent the revenue because this one, we know the standalone selling price as 40. This one, they don't know the standalone selling price, the customized training. So we'll just recognize the balance for that because the bundle together is 40. And they say that if they're supposed to sell software separately, we sell it for 40. They don't know the selling price for this. So we assume it's the balance of 10. So we won't recognize 50K and say that, okay, this is revenue for this service. No, would recognize revenue for separate performance obligation, for software separately, for customized training separately. And since they know the selling price of the software, so we recognize that as revenue. Then the balance to make up the bundled price, which is 10,000, we recognize that as revenue for the customized training. Now, look at another one. They said a network service company gives customers a free handset when they sign a 2-year contract for provision of network services. The handset has a standalone price of 200 naira and the contract is for 40 naira per month. How should revenue be recognized? Again, in this case, we have two separate services, free handsets and a network service. So we need to recognize revenue separately for each of them. So we have handsets and network service. I think we discussed something like this earlier on. And the network. So what's their SSP, their standalone selling price? The standalone selling price for the handset is 200 naira. The standalone selling price for the network is 40 naira per month and is a 2 years contract. So we should be looking at 40 times 2 years. What does that translate to? Anybody?
960.
960.
That
What
is
was that?
24 months.
Okay. What was the addition of the two? That should be 1160. So the proportion, this should be 200 divided by 1160. What does that give us? It should be 960 divided by
0.172.
sorry?
0.172.
Okay, let's say 17%. And let's say this is 83%. So the revenue will recognize this will be 17% times what?
That's 34.
160
17% times what?
times 1,160.
How can you, if you do that,
Mm,
I'll come back to 200. So how much are you collecting exactly? What's the consideration there? How much are you going to get? You're only going to get money from the network service. They are giving this one for free. So the
40.
revenue is actually the 960. This 960 is what you're sharing as revenue. So this one just helps us to know how to share it using the standalone selling prices. So we have 83% times 960. So what does this give you?
The first one, 163.2.
Okay, let's say 163. What about the second one?
796.8.
7.8.
Okay, let's say 797. So that's how this works. And you know that for this one, since this one is 2 years, you need to know that in year one, you only recognize half. In year one, half in year two, like that. In fact, you'll be recognizing the revenue on a month-on-month basis. Not that you recognize everything as revenue once. But this is how you allocate. So the whole idea here is that because these services are separate. So even though you are saying you want to give phone free to people, we are still going to recognize revenue on it because it's a separate performance obligation. So the bundle, the money you received for the two, which in this case, they are only receiving 40 naira per month, which translates to 960 naira. That's what we are going to share among those two services. And the basis of sharing will be based on their standalone selling prices, which for handset is 200, for network is 960. By the time we do a proportion, we're able to get this ratio. And that helped us to share that 960. That's the whole idea for step 4. This step 5 is where you recognize revenue as or when performance obligation is satisfied. So, a few things we need to note here is that performance obligation can either be satisfied at a point in time or over time, depending on the nature of the services. So if the performance obligation is satisfied over time, revenue will also be recognized over time. And this gradual recognition of revenue can be done using either the cost incurred to date, which we call impute method, or performance completed, which we call output method. Like us now at our school here, equity, we'll use output method because that have paid your fees completely now. We cannot recognize everything as revenue because we have not satisfied the performance obligation. And this performance obligation is satisfied over time. So if we were to recognize revenue for this month now, we would be recognizing, so far we'll have recognized like 2/4 in the sense that, let's say the duration of the class is 4 months. So we can use output method based on what we have done to date, based on performance completed. You can do 2/4 times the total money we have collected or that we are supposed to collect. And that is what we are going to recognize as revenue. And there are some where they cannot, they don't know how long it will take and all of that. Then they'll probably be using cost incurred to date to ascertain the amount they can recognize to date, like that. But if the performance obligation is satisfied at a point in time So revenue is recognized when the seller transfers control of the goods or services to the customer. And control is transferred to the customer where the customer has legal title over the goods. The customer has physical possession of the goods. The seller has rights to consideration and more like that. So all this signifies that, okay, now you have control. So immediately that is identified, then you can go ahead and recognize revenue. Let's look at this scenario. So they said a customer provides a cloud-based accounting software subscription for 12,000 naira per year, and the customer pays annually in advance. So for this one now, so revenue will be recognized at 1,000 naira, which is 12,000 divided by 12. So we just recognize 1,000 naira per month. But if I may ask you, since the customer pays in advance, and we are recognizing only 1,000 naira every month. So in the first month, if we recognize 1,000 naira, where would the other 11,000, where will we recognize it?
Contract liability.
Thank you very much. Fantastic. Contracts liabilities. Fantastic. That's absolutely correct. At least you remember that. Okay. Scenario 2. Sale with, okay, let's jump to the question. So a company sells an apartment unit for 500,000. The customer takes ownership, makes payment, and has no further involvement from the developer. So for this one now, so the seller, in fact, this is a performance obligation satisfied at a point in time. So the seller will recognize revenue when control of the property is transferred to the customer. So as soon as this is determined, go ahead and recognize revenue. The last scenario, a company sells an apartment under construction. The customer pays in installment and has legal ownership as construction continues. So here, Again, this is a performance obligation. So this is a performance obligation satisfied over time. So the seller will recognize revenue using either the input method or the output method, depending on the data available, or the output method. So if he has sufficient data, then to calculate using cost incurred to date, but he will gradually recognize the revenue over time. This one is not meant for you. It's beyond your scope. For you. So we have some questions here. There are some that are meant for you. Most of them are not meant for you. So the one that is skills. So the examiner asks that revenue from contract with customers, say, defines contract as an agreement between two or more parties that create enforceable rights. And I said, compare with necessary examples, contract liabilities versus contract assets. Standalone selling price versus transaction price. Using IFRS 15, I like 6 criteria to assess a contract. Explain what is meant by modification and state 2 ways in which. For this one, for these contract liabilities contract liabilities arises where an entity receives consideration and it has not transferred the promised goods or services. It can also arise where an entity receives consideration and the criteria for a contract has not been met. And the criteria for a contract has not been met. So that's contract liabilities. But contract assets is an entity's right to consideration where the receipt of the consideration is conditional on future performance. Let me write it in full. Where the right to consideration where is an entity's right to consideration for the transfer of promised goods or services, where the receipt of the consideration is conditional on future performance. You see, contract asset is different from trade receivables. So trade receivables also is an entity's right to consideration for the transfer of promised goods or services. But here, where the receipt of the consideration is only conditional on passage of time. So even though this is not required, this one is not required in the question. I'm just giving you to distinguish contract assets from contract liabilities, from trade receivables. So contract assets, you have delivered the goods, yes, you're expecting money, but your money is conditional on some future performance. You are still required to do one or two things. But trade receivables, you have delivered the goods, you have done everything, you don't have any other thing to do other than to collect money. The only obstruction between you and your money is just time. Maybe they tell you collect money in 30 days or 40 days. So, okay. So maybe the future performance, let me put it here that the future performance can be as simple as sending an invoice. So probably maybe you have not sent an invoice. Then it becomes a contract asset because that means you're still required to do something like that. Right? So I've already defined standalone selling price is the price at which an entity sells the goods or services on its own separately. Transaction price is the consideration expected from the transfer of goods or services. I've given you these 6 criteria. So contract modification is the change in the price or scope of goods or services. And you can only state 2 ways in which it can be accounted for. So it's either you're accounting for it separately and see it as a separate contract, or you would update and adjust the existing contracts. So those are the 2 ways available. And you are treating it as a separate contract if it meets those 2 criteria. That is, the change in scope is because of an addition of promised goods or services, and the change in price reflects standalone selling prices, like that. And in 2021, the examiner asked you to explain the principles upon which IFRS is based. I told you this one, that the core principle of IFRS 15 is to ensure that revenue recognized in the profit or loss depicts the consideration expected from the transfer of promised goods or services. Consideration expected from the transfer of promised goods or services. That's the core principle. And they also want you to explain the 5-step models. This one is just to give a brief explanation, very brief, not writing any, because it's just 5 marks, meaning you cannot spend more than 8 minutes. If you are writing everything I taught you, you're in trouble because you waste a lot of time. Just write a 1 sentence on each of them, then you're fine. So this one is a professional question, doesn't concern you. Deep IFR, I'm not solving this for you. Deep IFR, no. Professional. So you guys don't have much to do there. Okay, so we are done with IFRS 15. Do we have any questions? You guys have tried. You tried. We spent our hours completed today. So, sorry,
I have a question.
to make any announcement. Yeah, you ask a question. I just want to mention something. So tomorrow our class will come up earlier, between 10 to 12 tomorrow. Then after that one, I would let you know whether we'll have class in the evening or not, depending on how far we're able to cover what we're supposed to cover within that period. So, but ultimately, for the whole of September, we'll be have it in mind that we are going to be having 10 to 12 on Sunday. Just put it in your schedule for the whole of September, just so that we can fast track what we want to cover. And we are also going to be having classes in the evening also, just so that we can, because in October, I want us to have very little things that we have not covered, because that time your exam is very close. So if you have opportunity to move at a considerable pace, good for us. So just we'll meet tomorrow at 10 to 12, and we're going to be looking at IAS 10 on revenue from contract with customers. After IAS 10, I'm moving to IFRS 16, operating lease. Then from there, after leases, I will teach you group accounts. I want to take away group accounts. Then after group accounts, when we come back, I'll be teaching you ratios, EPS, sustainability reporting framework, then IS 21. Then after that, we have very little that is left. It's just for us to start solving question unpublished from your past questions, and let's see where that takes us to. But we're doing very fine as far as this your syllabus is concerned. Okay, Moses, now you can ask a question. Then after Moses, I'll take Joseph. Let me start with Moses.
Okay, thank you for the lecture. But I want to ask if this is where the syllabus for skills for this year ends, because I still know that IFRS 15 is a bit wide. We still have SOR as well as what's it called, warranties also. But my question is, this where the syllabus for our level stops?
Yes. Which is why I actually removed those other parts that are meant for professional strategic business reporting. I just removed those parts. They are not for you, they are for that level. So this is where your own ends for you. But that does not mean if you have plenty of time at your hand, you cannot read it on your own. Of course, it's nice, but it's not required for you.
Okay, thank you.
You're welcome.